Welcome to the M2I Alternative Investments Chat, where we demystify the world of alternative investments and financing for entrepreneurs and investors alike. With these discussions, we hope you're more empowered to unlock new opportunities in your business or portfolio.
Hello, and welcome to M2I Alternative Investment Chat. I'm your host, Erica, here with Erin. And today we're diving into the topic of capital planning. Effective capital planning is the cornerstone of any business's success. It provides a roadmap for sustainable growth, financial stability, and frankly, it's how you make good business decisions. So let's dive into that and talk about capital planning.
Yeah.
So Erin, what is capital planning?
Yeah. Well, that's why we're here today, right? Let's figure it out. Capital planning is the process of budgeting your company's resources for your ongoing long-term plans. This includes projection for future projects and their potential gains and losses. This process involves developing a strategic plan for allocating financial resources and ensuring that capital projects are aligned with the organization's goals. A well-developed capital plan is crucial aspect of a business's financial success and how you make good business decisions, as you mentioned. And it allows organizations to make those good business decisions about where to invest resources to achieve their growth objectives, maximize shareholder value, and maintain competitive edge in the marketplace. Furthermore, capital planning helps businesses minimize investment risk by identifying potential threats and developing strategies to help mitigate them. So first off, let's talk about the capital planning process. First step, you have to identify your capital needs. How much capital do you need? How much capital do you require? You have to assess your company's current assets, forecasting for future growth, and analyzing industry trends, where you think this potential market is going and how your business fits in that. And this includes evaluating the organization's existing infrastructure, equipment, technology to determine if they're adequate to meet its short-term and long-term objectives. Do you need new equipment? Do you need a new business space? Is your business expanding so rapidly that you're going to outgrow the place that you're in? Those are things you have to think about.
Yeah, I think a lot of people don't realize when they're going into capital planning that everything takes into account, like you said, from the physical building to the laptops, the pens, the pencils, the paper, the toilet paper, and the restrooms. Like, you can't run out of that kind of stuff. Like, that all has to be accounted for.
Right.
And so having to identify that, you've got to first, like you said, look at the infrastructure of your company and make sure that you've actually looked at everything from top to bottom.
Yeah.
No pun intended.
Exactly. Everything that costs money, that's what you have to think about, and where that money is going to, being allocated to. So companies should assess their growth potential by analyzing market trends, customer demand, and competition to identify areas where investment might be required. Where's a place in your company that you might require outside money coming in so that you can continue to grow with the times? Forecasting future growth is critical to identifying capital needs, as it provides valuable insights into the company's potential revenue streams and resource requirements. And lastly, companies would utilize or should utilize historical data, market research, and industry analysis to create accurate growth projections. So if you are in a industry where you're seeing there's been rapid growth and it's projected to continue to keep growing, then you're going to want to continue to put capital behind that so that you can continue to grow with that trend. And, conversely, the other way as well.
Yeah.
And if you understand those industry trends, it's essential for identifying opportunities for investment and potential challenges that may impact your organization's financial performance. It's huge.
Yeah.
Erica, can you tell us a little bit about budgeting techniques that a company might use when capital planning?
So the next step after identifying, how much capital you need to make sure you're doing these budgeting techniques. So first, you want to make sure you have a payback period. So this is a simple capital budgeting technique that calculates the amount of time it takes for an investment to recoup its initial costs through cash intake. It's useful for comparing investment options with similar risk profiles, as it provides a straightforward measure of how quickly an investment will generate positive revenue. So you want to make sure you can pay back the money. Then there's a net present value or an MPV. So the MPV is a little bit more sophisticated budgeting technique that accounts for the time value of money by discounting future cash flows and their present values. A positive MPV indicates that the project is expected to generate a greater return than the cost of capital, making it a potential worthwhile investment. Obviously, when it goes up, people want to get in. But in contrast, a negative NPV suggests that the project's returns are unlikely to cover its costs. So you want to make sure you're figuring out what structure you're going. NPV is widely used by businesses to compare investment opportunities and determine their financial viability.
Yeah.
There is next an internal rate of return. I think we've kind of heard that term in passing, and it's called the IRR. So the IRR represents the annualized return, the rate of return in which an investment breaks even. So you're not making any money, you're not losing any money, just got enough to zero her out. The IRR can be used to compare the profitability of different investment options, with higher IRRs generally indicating more attractive opportunities. It's important, though, to note that the IRR assumes that all future cash flows are reinvested at the same rate, which sometimes is not the actual case.
Yeah.
So we got to make sure that that is taken into consideration. And then lastly, there is the profitability, or actually there's two more. So there's the profitability index, or the PI, not a private investigator, but the private, then I'm going to say private investigator now. So the profitability index measures the relative profitability of an investment by math equation, by dividing the present value of its future cash flows by the initial investment cost. So the PI is useful for comparing the relative profitability of different investments options. And it takes into account both the size of the investment and the potential returns. And then you've got the modified internal rate of return, so the MIRR, a variation on the IRR that addresses some of its limitations by considering the cost of capital and its reinvestment rate. Like we talked about on the IRR, you're assuming that you're investing at the exact same, which might not be the case. So the cost of the capital and the reinvestment rate of the cash flow separately. So that's the modified. And the MIRR provides a more realistic measure of project's profitability, accounting for the actual reinvestment opportunities available for the company, instead of that just, oh, we're going to do the exact same thing over and over and over again, even though that might not be. And then the last step, so after you have determined how much capital you have, making sure that you can pay it back, there's one more step.
Yeah.
And that's what?
Actually sourcing that capital.
Yeah.
You have to find it. So in the previous episode, we actually broke down 3 different ways that you can raise capital: equity, debt, and debt plus equity, known as a convertible bond. So here's just like a very quick overview of those 3 things. So starting with equity, it's an offering that involves selling a portion of your company in exchange for capital coming into your company. So you're bringing in investors who actually own a piece of your business. Debt offerings include borrowing money from folks, and then you're paying that back over time, usually with a high rate of return for those investors. So you're actually not giving away any piece of your company. You're just borrowing that money, and then you'll pay it back.
That's right. I remember that.
Yeah. And then a convertible bond, which is that debt plus equity option, is a fixed income corporate debt security that yields interest payments but can be converted into a predetermined number of common stock or equity shares. So you can see those, it's like the little hybrid, the little baby of the two.
I like that one.
So, of course, we always want to talk about risks. And with capital planning, you want to make sure that you are assessing risks within your company, in order to accurately determine exactly how much capital you need, or what sort of risks you might be entering when acquiring that capital. So you need to make sure you're identifying and assessing those potential risks associated with your investments. And this includes analyzing various factors such as market conditions, economic trends, competitive dynamics, regulatory developments, to determine the likelihood of that potential impact and the various risks on your company's financial performance. Risk assessment should be ongoing. So you don't do a risk assessment once and then say, I did it, I'm done. That's an ongoing process. New risks may always emerge over time. That's just the way that life is. Or existing risks might be mitigated or go away. So you want to continue updating your analysis of your risks so that you can really understand the position that your business is in.
Yeah.
So, Erica, along with risk, can you tell me some risk mitigation strategies that exist?
Yeah. So once you've identified and assessed in your business what those risks may be, you want to then start, to mitigate their potential impact on the capital investment. So this can involve a range of approaches, such as diversification, hedging, and insurance. So diversification is simply spreading investments across a range of projects or asset classes to reduce the portfolio's overall risk. Again, spreading it all out so it doesn't hit. If something hits, you still got it all spread. You're not worried about that.
Yeah.
Hedging involves using financial instruments such as options or features, contracts to offset potential losses from an investment. Again, kind of spreading it out. And then lastly, there's insurance. So you can use this to transfer certain types of risk to a third party, such as a property or casualty insurance or even credit risk insurers. Now, you will most likely pay a premium for that insurance, but again, it protects you and your investors. And then there's always, contingency plans. So you want to make sure that this is an essential component, should I say, of risk management, a contingency plan. Always, backup to a backup to a backup, just in case. It involves developing alternative plans or strategies to address potential risks that may materialize during capital investment. You never know, something comes up, or like you said, the risk that you thought that, that Y2K that we all thought everything was going to crash, didn't. That risk was mitigated, you know what I mean? But we all thought for a hot minute there that everything was going to go up in
You
flames.
talk about this a lot. We need to dive into that. at some
Y2K?
point. Yeah, then the source of your trauma.
That's
Y2K.
I need my computer. What are you talking about? That's the source of my trauma. And I had a contingency plan. We had, analog batteries waiting. No, but you have to, you never know when something's going to give up or change. Contingency planning helps businesses to be better prepared for unexpected events and to minimize the potential impact of risks on their capital investments. Again, you don't want to show up and everything go crashing around you.
Right. Well, there's that saying, you don't want to be caught with your pants down.
I was trying to avoid saying that.
Well, I said it anyways. It's having that plan B, right, and being prepared.
So what are some good practices with capital planning?
Yeah.
Give me a few of those.
So with capital planning, you'll want to involve stakeholders. Well, you don't have to, but it's definitely a best practice that can help everybody feel like they're on the same team. By engaging stakeholders, you can actually gain some additional valuable insights from those folks and identify potential risks and opportunities. And it helps everyone understand the strategic objectives of that company. Okay. Also, you'll want to make sure that your capital planning is aligning with the overall business strategy, and that will ensure that investments are directed towards projects supporting the organization's long-term goals and objectives. So everything's in line. And you'll also want to regularly review and update those plans. Capital planning is an ongoing process, much like those risks. It's ongoing. It's not just something that happens one time. And it requires a regular review and updating to reflect changes in the company's financial position, market changes, and strategic priorities as well. And also, always ensure transparency and accountability. I don't know how many times we've said that on this podcast, but that helps people build trust amongst your stakeholders and ensure that the investment decisions are being made for the right reasons and also in the company's best interests. So as we're kind of closing out this podcast, here are a couple of the key points that we discussed. This is your little spark notes for the day. Capital planning is a process of determining how an organization will allocate and invest its financial resources to fund long-term projects, acquisitions, or expansions. Capital planning is essential because it helps organizations prioritize and make informed decisions about allocating funds to projects that will generate the most significant returns or strategic advantages.
Yeah, and capital planning helps organizations maintain financial stability by ensuring that sufficient funds are available for strategic investments. They manage debt, equity ratios, and minimize the risk of financial distress. Risk assessment, like we said, is a crucial component of capital planning as it helps identify potential risks associated with investment projects. By evaluating these risks, organizations can make informed decisions, developing mitigation strategies, and allocate resources more effectively. And then last, capital planning should be reviewed and updated regularly to account for changes in marketing conditions, business priorities, and financial goals. But as always, we encourage you to prioritize capital planning in your business strategy and do your research to ensure that you are putting those resources in the right spot.
Absolutely. We'll see you next time.
Thanks for joining us. Stay tuned for more insights in our next episode. And don't forget to subscribe to continue the journey with M2I. See you next time.
The content provided in this podcast is for informational purposes only and should not be construed as professional, financial, or investment advice. This podcast should not be construed as an offer to sell or a solicitation of any offer to buy any securities. We strongly recommend that you seek advice from a qualified professional before making any financial decisions.